So you want to know if this whole be your own bank with life insurance thing is for real or if it's just a big scam. I get it. You're skeptical. You have reason to be. Why? Because we're talking about two financial things that people probably hate the most. One is permanent life insurance, and the other one is pairing it with debt, borrowing against it. So you're like, I've heard both of these things are bad, and now you're telling me to do both. This is crazy. I get it. It sounds ridiculous, but it actually works. And case in point, what we're going to discuss in this video are how banks themselves, major corporations, iconic entrepreneurs, famous people that you probably have heard of in the sports world, all doing this on a big scale. Did they just get scammed by some slick insurance agent? No, there's actually some substance and weight to it. And you might say, well, they're all bigger, richer than me, so it doesn't apply to me. Guess what? They're doing it for the same reasons you would want to do it. One is they want a safe and predictable yield while still maintaining liquidity on those safe assets, as well as some tax benefits because life insurance provides a social good for widows and orphans and failing businesses with key person insurance. The IRS is actually going to afford you some really nice and unique tax advantages. So that's why you do it. Let's talk about why you wouldn't, or at least why you've heard you shouldn't. Let's see. You've heard things like, I've always heard that whole life is bad or expensive. I've just heard that these guys are selling it because of really big commissions. I've heard that you should just buy term because you won't need life insurance when you retire. And so just buy term because it's cheaper and invest the difference. And insurance should be insurance and investments should be investments. Chances are that's what you've heard. And what I know that most people do when they're researching, they call this research, but this is not research. They do something I call polling opinions, where they basically say, I'm kind of curious about this thing, so I'm going to ask around. But who are they asking? Are they asking experts in this field? Are they asking people that have special knowledge? No, they're asking people that have been in the same echo chamber as you have, that all those things I just mentioned, people have been parroting, just like parrots, for the last several decades, and without really grounding any of those opinions with facts. And that's what we're actually going to do in this course, some of which in this video. So who should you be asking? Well, what I can tell you is if you actually go through this knowledge, which it won't take very long, you'll know at the end of this video whether or not you want to even proceed. And I think you will. But if you do, you'll probably know more than certainly the people that you're pulling opinions from, and you'll probably even know more than a lot of agents out there selling it. And that's part of the other reason why life insurance has such a bad rap. The insurance industry has done a terrible job training people, terrible, to where there's like a 90-some% attrition rate, meaning like more than 95% of people who enter the life insurance industry fail. They actually leave the business. They don't really know what they're doing when they're selling. They go out and sell their friends and families, and insurance companies hope that some of this business sticks. They're throwing poop against the wall and hoping some of it sticks. Not a very good look for the industry. Conversely, the Wall Street stock jocks of the world, they've done a great job. And why do I say that? Because there's been multiple times, even in the last couple decades, where stocks have lost 30, 50% of their value, 20% of their value in very short periods of time. And then when that coincides with people's retirement or their financial goals, say they were saving for a house or whatever that is, that may have derailed their plans. But yet people protect them. It's almost kind of reminds me of the battered wife of the alcoholic, where it's just like, oh, he didn't mean it. He won't do it again. He's gonna get better, I promise. and yet they defend it, and they defend the stock market so blindly. Like, well, it averages 8%. Well, that's fine. I call that the flaw of averages. If you go ahead and put your one foot in a bucket of boiling hot water and put another foot in freezing cold water, on average, you feel just fine. But that doesn't mean that the average is going to happen to you, especially when it coincides with your retirement. The other thing is like it'll always come back. Sure, it has to this point, and that's mainly because we've pumped trillions upon trillions of stimulus into the system, and we're kind of running out of Band-Aids. And at some point, we're going to have to feel some pain. Like if I ask most of you, do you think our economy is out of the woods yet? Do you think we deserve to be at record highs? Most of you are pretty intelligent people, and you're going to say no. But yet, if I look at where you have most of your money, you're going to have somewhere between 80 to 90% riding that horse. And part of the reason why you do that is you don't have a better way to, there's no place to run. There's no place to hide. And so you do that, and you do that kind of with a sense of gambling and kind of with a sense of hopium, right? You're hoping that works out. And this is where I say the life insurance industry has done a crappy job, because there are products that you can go and you can hide. At least you can earn a safe yield. You can keep up with inflation to some degree. Now, obviously, that's going rampant, but you can also stay liquid. So if for some reason it doesn't, you can access 95% of your wealth and put it in something that is, whether that's precious metals, whether you just want to flight to cash, whether you want to get into whatever you want to get in, whether you want to invest in your own business or real estate, whatever opportunity comes your way. But at least in between those projects, you can put your money in a place that is safe, that is liquid, that is growing, that is tax efficient, not to mention it hedges some other benefits. So let's take a look at some examples of the people that you should be polling. Like, part of the reason why you poll your brother-in-law who's an electrician, or you poll 3 other people you know that bought insurance from some of these crappy agents that we've talked about, or your parents or whatever that don't really know any more than you. They've just heard all the same kind of ungrounded opinions. And the people you should be polling should be maybe the CFO of some of these major banks that have 20 billion of permanent life insurance or more on their balance sheets. Why would they do this? Why would they do this? Well, we mentioned a couple of the reasons before, but mainly if you think that the way that a bank makes money is something called fractional reserve lending, where they need $1 on their balance sheet to be able to go out and lend $5, $10, $20, depending on whatever the fractional reserve lending algorithm is at that time, they need deposits. So one of the other things you're probably asking yourself is, why haven't I heard this before? Well, part of the reason you haven't heard from them is because they don't want you to know it. If they said, look, we're taking a very large portion of your deposits and we're putting them on overfunded life insurance policies that we do on the lives of our key executives, not only as a key person protection, like maybe like you should do on your family, but also as a private retirement benefit we do for them too, that maybe you should do for yourself. And it's done so because it's a very mathematically and tax efficient way to do so. If they tell you that, what are you probably going to do with a good chunk of your deposits in that institution? So if your broker at Wall Street says it's a bad deal, let me ask you something. Do you think he's giving you a totally unbiased opinion? Or is there a little bit of a conflict of interest? Now, first of all, let's just say, I don't think most of them are bad guys or gals. A lot of them just don't know, because I know this firsthand. When you come into the business, you come in on one side of the fence or the other. And what the industry should do is they should educate both camps, the insurance camp, the Wall Street camp, on both products, because people would be better off mixing and blending both products. And how much in the way of stocks, how much in the way of insurance really will depend on your own risk tolerance, on your own preference, on your short and long-term goals and what that looks like. And it should be tested in measures. But instead, since both industries have been competing for the very same dollars for decades, what they do is they bash each other. And it's unfortunate. And I've been on both sides, right? The stock jocks bash insurance. The insurance camp bashes stocks. Oh my gosh, you're going to lose all your money. It's horrible. Give it all to me. We'll put it all in the whole life. And I've seen them both. And what I can tell you is each one separately isn't as powerful as if you have both together. And a lot of my competition won't say that, right? There's a little bit of a conflict of an interest there to say, hey, put as much as you can in life insurance. I let my clients decide that for themselves. But going back to the stock jocks, your broker, I've had several say this, like, we don't even need life insurance. I could do the same thing with bonds. Really? Can you? Last time I checked, when interest rates go up, the value of bonds go down. which way do you think interest rates are going to be heading from here at some point? Now, we may be depressed for a long time in terms of interest rates, but at some point, I don't know if you can say that, Mrs. Broker, versus with something like whole life, where it is guaranteed to go up every year, no matter what. Depending on what product type you have, it could be 2%, it could be 3%, it used to be 4%. I think now it could be as much as 3.75%. But if you had not only a floor where you didn't have to worry about losing principal, but it could grow and it could spit out a yield that is actually more competitive than owning bonds in the same risk profile. And what I mean by that is, if you want to go ahead and call it 4 something percent, you can't even get investment grade bonds, which are still allegedly not as safe as treasuries or munis, right? If you want munis or treasuries, you're talking 1 or 2%. And if you want 4 to 5, you got to go into junk bond land. And in order to do that, you have to pay tax on that yield. And they'll say, well, wait a second, you can put it in an IRA or Roth. Fine, you could, and avoid that tax, but then all of a sudden it's not liquid. So last time I checked, there is no product that Wall Street offers that could kind of take the best of all those worlds and combine them in an offering where you earn, call it investment grade to junk bond style yields, but with treasury and muni bond style risk. I would say even less. And the banks themselves will tell you that, because they'll actually lend against 95% of whole life cash value. I don't want to tell you something, because if you want to borrow against munis, they'll only lend you, even against like the highest grade insured munis, they'll only lend about 60 to 70 some percent, maybe 80 on the very high end, because they know there's still price fluctuation, versus they know that the contract of whole life, there are rock solid guarantees. So the fact that banks themselves will tell you, we'll loan 95% on whole life, ought to tell you something about that risk profile. So it's actually not even like treasury and munis. It's actually more like CDs and cash to have closer to that risk profile, but still be able to earn the yield of something closer to investment grade bonds or junk bonds in a tax efficient wrapper, a tax exempt wrapper, as long as you structure and use the product properly, and still have it be 95% liquid. Like, there is no such thing on Wall Street. So when these guys say we can do the same thing, it's usually from a lack of knowledge. It's either from a lack of knowledge, or it's from an extreme bias and conflict of interest that they don't want dollars leaving their coffers, because that's how they're paid. Which brings me to the next point. We talked about commissions. But wait a second, Hutch, you make a really big commission for selling whole life, don't you? Depends on how you look at it. So I could, if I wanted to, but because I know how these products are designed, there are actually ways to design the product to where it is less death benefit focused. So contrary to popular belief, the amount of money I make is less dependent on how much money you put in and more dependent on how much death benefit you're buying. And the IRS actually gives us very clear guidance. It's not like stated like a 401k maximum or an IRA maximum, but it is in the software. So for any given age and health rating, they'll tell me the least amount of death benefit I can wrap around a certain premium dollar, a certain amount of cash coming in, and still have it be taxed or treated favorably like life insurance is. They'll actually give me that in black and white. And when I do that, when I shrink wrap the least amount of death benefit possible around your cash, guess what that does to my commission? It shrinks it, right? There are also, depending on the product type, there are also certain types of term riders we can add to the product that reduce that commission further and allow us to put in more money that goes straight to your cash value growth and less to commissions. Now, why do we do that? We do that because it's what's best for clients. That's how we structure our own policies, and we make it up in volume. So we have so much business coming in online that we don't need to play games like a lot of agents have. Going back to the life insurance industry has done a crappy job. About 95% or more of agents that enter this business leave. And so when they kind of got somebody on the hook there, they got to figure out how to maximize that opportunity. And so it's not very well known how the sausage is made, let's just say. And so it's a little easy. It's not too difficult to be able to bake in a little extra fat, We just cut through all that crap and we design products the right way the first time when people come to us. We know when they come online, they have zero allegiance to me, right? They are talking to somebody local, they're talking to 2 or 3 other online operations, and this goes back to the polling opinions. Hey, I'll shop it here and kind of look, and y'all don't know what you don't know, but you're like, okay, this illustration looks better than that one, and so I think I can trust this guy and not that guy. We just do all the shopping for you, right? And we're happy to take the Pepsi challenge, and most of our clients figure out very quickly that we don't really have time to screw around because we're quite busy, and I've purposely created our business on a skeleton crew because I don't want extra complication in my life. I want to do business with people, and this includes clients, but also I'm talking about my employees. I want to do business with people I like, with people I trust, with people I actually want to spend time with, because I only have so much time in the day. And so do my guys. So what I would tell you is, if you are still concerned that this thing is for real, I'll give you a couple more examples now. If you Google right now, Walmart life insurance lawsuit, what you're going to find is Walmart was sued for taking out policies on massive swaths of their employee base. So basically, they heard of this concept so much, they were dealing with banks. They realized that banks were making a fortune off of their deposits and withdrawals. They needed liquidity to go ahead and expand and buy warehouses and trucks and build stores and all these things. Run inventory through the shelves. Why let the banks keep all that profit when they could run it through their own coffers and create some arbitrage? So you can see very clearly, if you Google that, that Walmart was sued for taking out secret life insurance policies on employees. So you're limited. It's not like a product that you can just go to your stock jock and say, I want lots of muni bonds. Like, you can't just say, I want gazillions of dollars of insurance. You actually have to have a reason to take out insurance on somebody. The insurance company is not just going to give you an unlimited amount, or you can't pick that guy and say, I don't think he's going to make it that long. I want to buy insurance on that guy. They're concerned about a moral hazard. If you've ever watched Dateline, you understand why. But that's why you're limited by the amount of bodies you have, or the quality of bodies you have. Walmart had a lot of bodies, and so they kind of pushed the envelope. The IRS actually does have limits to only being able to do highly compensated employees or people that are key to your operation. Obviously, Walmart crossed the line, and they got their hand slapped for it. All I want to say about that is, why would they be doing that if it was such a bad deal? Or if all those things you heard, right? It's expensive. There's a massive commission. You should just buy term. Insurance should be insurance. Investments should be investments. Like, why would Walmart and these banks do it? What about famous entrepreneurs? I have a great article. If you type in bankingtruths.com/Walt, it's Walt Disney, Ray Kroc from McDonald's. If you watch that movie with Michael Keaton, bought out the McDonald's brothers, and J.C. Penney. Now, they each use their life insurance in a different way. They each had it, and it either helped them start, grow, or save their business. But when the sky was falling around them, or they couldn't get liquidity, or the banks wouldn't provide them liquidity because they didn't see the vision of their dreams. I love the saying by Bob Hope that says, a bank is a place that will loan you money if you can prove you don't need it. All of these entrepreneurs lean on their own life insurance cash value and borrowed against their life insurance to go ahead and either start, grow, or save their business. That ought to tell you something. It also should tell you there's been books, several books, some of them better than others, but a lot of people love to canonize the ancient text of infinite banking. What I say, it's been happening ages before any of those books. And what you all should be doing now, certainly I revere the early texts and give credit where credit is due for bringing this strategy to light. Otherwise, I wouldn't know about it. But what we pride ourselves on is making the most modern day and mathematically efficient interpretation of that, right? And it's all about arbitrage. It's all about maximizing liquidity, maximizing living benefits, and obviously, needless to say, a book that was written 20 some years ago, it's almost 30 years ago, cannot be relevant today in a mathematical context, because there's already been 2 to 3 major changes, iterations in the industry itself. But the concept is pure. What are some other examples? College coaches. You Google Jim Harbaugh life insurance. You'll see a great article by ESPN and some other insurance people that jumped on this. But ESPN was the original reporter of this, and I remember when it happened, it was awesome. It was mind blowing. And I actually know the agent that did the Jim Harbaugh case. It was actually through University of Michigan. They offered Jim. It's an executive benefit. It's called split dollar life insurance. It's tax efficient. It does involve loans. And you would have to ask yourself, well, Jim is just a regular guy like us, meaning he's not an institution. There's no special products for him or anything else. He actually got a retail product, the same type of stuff that you could get on your own or with us. Jim got that. Why would he do that and borrow to do it when he could just say, you know what, just give me the cash? Is he a dummy? No, he has a lot of advisors and gatekeepers around him. They're not going to let him do that unless it made a ton of sense. And it made so much sense that you see that Dabo Sweeney, and I think his name is Oregon from LSU, not a huge college football fan, but those of you that are know who I'm talking about. Coach of LSU, the coach of Clemson followed suit, and there's lots of others. You can just Google. It's public knowledge out there that they all have these split dollar life insurance plans. So why would they do that? It's the same reason you should explore further. Not saying you need to do it now, but the least you should do at this point is say, okay, I get it. Something good is going on here. The people I've been asking about it probably aren't knowledgeable enough to give me a good opinion. So even though I can go find probably 99 no opinions for every one yes, you should spend some more time finding the knowledge you need to see if you should pursue this further. And that's what we're going to go into in the rest of the course. So at any rate, I hope you found this valuable. There's going to be some additional resources on this page where you can go and explore further some of the things I talked about to really see if it's for real. And I think you will find that it is, and it is worth exploring further. So with that, we'll see you on the next video.